It's Brian Preston, the Money Guy.
I want to talk about how investing is simple.
Okay, Brian. Now, you make me nervous when you make statements like that because we make a living, right? One of the things that we do in our day job when we're not doing the show is we help people do financial planning and come up with strategies for reaching financial independence. And a big piece of what we're doing is investing, is helping people choose how to do their dollars. And what you're saying is, investing is simple. It's easy. It's a piece of cake.
You want to know when you have complete confidence in what you do for a living is when you are willing to be not literally naked. I mean, I'm going to keep clothes on around people, but I am willing to lay bare what I believe about, from my experience of managing money with my own money as well as clients' money for going on 3 decades, is that, I mean, it really is. These principles are simple. They're easy. I don't mind you understanding it because I think you're still going to need me for some of these other things. You know, you're going to be so successful, you're still going to want somebody looking over your shoulder, but you're not going to have to buy the private placement. You're not going to have to do the hedge fund. You're not going to have to get into venture capital and all these other crazy things that lock up your money or some complicated insurance strategy. You don't have to do this stuff. So let's kind of jump into what do I mean when I say investing is simple. And look, Bo, I know we both. I don't want you guys to think we've always been purists and had this all figured out. I know both of us are sitting on residual accounts as memories and reminders of bad decision making. So you confess yours and then I'll confess mine.
Yeah, so when I first was thinking about getting into this industry, and I was in college, I took my very first investment course where I got to learn about stocks and bonds and mutual funds and how it all worked. And after sitting in this course for about half a semester, I was pretty much a genius. I knew how to invest. So all these folks who were out on Wall Street trying to do it, they didn't have it figured out like I did. So I went out and I bought some individual stocks because I had some insight around like some mergers between satellite radio companies and some toy companies that had a recall. I had it all figured out. So I made the decision I was going to go buy some individual stocks and it was going to just go gangbusters. Well, I learned very quickly, because when I was buying these stocks was around 2007, 2008 time frame, maybe a good time to invest, maybe not. I learned very quickly that what I thought I knew wasn't something I actually knew. So I've actually I have 3 stocks that I bought that I still own today in very nominal amounts relative to my total portfolio. And if I can, I will never sell them to always remind me to never think that I'm smarter than I actually am when it comes to investing.
So my confession, I don't know if to blame you because you are the schemer. You know, if y'all didn't know, Bo is this brilliant guy who passed all 3 parts of his CFA exam, first attempt, with the last one being a week before his wedding. Who does that? You know, where you schedule to take all your CFA exams and you don't have any barrier or, you know, you don't have any buffer.
Right.
Because if you wouldn't have passed that last one, you're going to be married, time was going to be limited. But so Bo, because he's educated, brilliant investment guy, and while you were doing all this, I think it was while you were doing your CFA.
Oh yeah, it definitely was.
We decided we were going to start doing some option strategies
because we were smart.
And here's the worst thing that can happen to you guys when you start doing complex strategies is to be right the first time.
And we were so right the first time.
So here's what we did: is I just put a few $1,000 in the first time. And then we made 2 option calls. We bought some calls on one thing. We bought puts on something else. So we're betting for one thing. We're betting against something else. And guys, the money doubled, I kid you not, in less than 3 weeks.
It was awesome.
We doubled that money in less than 3 weeks. So we were thinking,
we're on to something.
We figured this thing out. What are we doing? I mean, and I will tell you guys, I still keep that $167 account to show me that you can blow money so quickly in options that it's just not worth it for me. Now, look, I'm not throwing options completely under the bus because I've done some great strategies for concentrated positions. You can do some collared strategies, some hedging strategies. There's some great things. So,
but we were
Don't
speculating.
misread. But I was straight up gambling. It's even a leg above speculation in the fact that we were totally throwing it up against the wall to see if we could do it. So I've had failures. But I can tell you, after managing money for successful people as well as seeing what does and doesn't work, simple is your friend. And I want to talk about now what's important.
Sure.
Let's kind of transition. Here's the first thing. Number 1 on what's important and how to keep it simple with investments is asset location, asset allocation that reflect your age, goals, and complete risk profile, That's what's important.
Yeah, I think it's so beautiful the way you said that, because a lot of folks understand and hear about asset allocation. Oh, okay, I know where you're going to go. You're talking about diversification. I should have stocks and bonds. Yeah, that's part of it. That's a big piece of investing. But how you spread out your money is important, but equally as important is where you spread out your money, the types of accounts that you house and how efficient it is. Because the unfortunate truth is two things are certain. We always say Ben Franklin said this. I don't think he really said it. Two things are certain: death and taxes. So you can't get out of taxes, but if you're going to pay them, you ought to try to pay as little as possible. And we always talk about this too, Brian. Tax evasion is illegal to get you arrested. Tax avoidance, highly encouraged.
It's true.
And the system is set up to allow you to do that.
The other thing I always tell people when we're talking about just asset location, asset allocation, is understand that risk has many components. There's risk tolerance, which is, are you going to lose your mind if the world, if you start having some volatility? Yep. But then there's also what's called risk capacity. And I tell this to my cowboys and cowgirls out there, is that you could get to the age, and look, I'm an optimist, so I'm always going to be the person that, I came out in the mid-90s, you came out in 2008, so you're kind of the pessimist, I'm the optimist. So I actually like having more equities than probably most people, but I do think as you get closer to the point where you're living off the assets, you got to understand what's going on with the asset allocation. Asset location, this is one of those things, because we tell people all the time, when you're younger and first starting out, buy those target retirement funds where you get in the first 100,000, 200,000. But I will tell you, you're going to notice that as you get more assets, tax location means something in asset location. But keep it simple while you're young, less than 200,000. Buy a target retirement fund. Keep it simple, and you're going to be okay with that. So number 2, on how do you keep it simple and what's actually important with investing, can create a consistent savings plan. I mean, if you can put the money just automatic for the people, have the money going in every month, half your job is over. And it also makes you a contrarian and a financial mutant, because when the market's getting beaten up, you're actually saving more money. I mean, you're getting more money to work for you. It's an incredible opportunity when you set up a systematic plan. One
of the biggest things that breaks my heart, Brian, is I'll have young folks who will come and ask and say, hey, I'm ready to start investing, and I've got this money. I'm ready to put $6,000 into my Roth IRA. And I say, awesome, that's great. But so often I'll see somebody do that, and they'll put $6,000, they'll go buy the S&P 500, or they'll go buy a target date retirement fund. And maybe they just did it at a bad time. They bought at the height of 2007 and then 2008 happened. They're like, oh man, I hate this investing thing. This isn't going to work for me. Or even worse, they say, you know what? I'm going to invest this money, and that's my retirement fund. I'm just going to put this $5,000. Investing is just sort of a store of value when we have money that we want to put to work. It is a means to the solution. It's not the solution in and of itself until your portfolio gets big enough for it to be the solution. So not having it consistent, not having money going in all the time, I think is setting you up to not be a success, at least until you get to the point that you do have that big, healthy, diversified portfolio.
I'll give you an example. Back in the mid-90s, I came out of school, was working in public accounting, but I came across that book, The Wealthy Barber. Read The Wealthy Barber, and then I started giving it out to my buddies. Because my wording at the time was, guys, I need you to read this book because I'm going to have money one day, and I'd like to have friends to hang out with. So you guys start reading this book too. And here's what I think is crazy: is a few of them, everybody got energized from reading the book. And I had a few that actually set up IRAs. Put the money in, but that was it.
And they never did anything else.
It's like you go to a conference. What happens when you leave a conference? You're ready to run through a wall when you come back. There's a reason Tony Robbins can have people cross pits of fire. It's because you go through a conference. We could probably get you guys motivated, but if you don't create a plan of action that's going to think outside of when you get that initial motivation and excitement, it doesn't fulfill with all your desires. So that's why I like consistent savings plans, is because they let you take that initial burst of energy, but it gives it a legacy. So that thing keeps working even after your excitement might die down. I have several clients, and I saw, you guys, whenever you get a free tumbler, we always have you write matt@aboundwealth.com. Matt serves as a secondary on me on one client. And every time we have a meeting, I'm like, that guy right there is wealthy because I have dragged him across building a savings plan, because he's just not wired to be a saver.
Yep.
But every time we had our annual meeting, I'd be like, come on. I mean, look at your income.
Yep.
You got to increase your annual savings. And then Lord, he's been a client for over a decade now, maybe even 15 years at this point. And
he's got a great portfolio.
He looks at his portfolio and he goes, how did we get here?
Yeah,
I mean,
that's right.
really, if you will do that with a consistent savings plan, it will happen for you. So save 15 to 25% of your gross income. That's simple, and that's going to be the thing that is going to change your life. You won't miss it if you structure it properly.
That's right.
And you can keep that and look, I understand there's some 26-year-olds watching this. They're like 15 to 25%.
Not a
That
chance.
old guy right there is clueless on how hard my money is right now. I get it. But you can go ahead and start with maybe 5% or 7%, or at least get the match from your employer.
Yep.
But then when you get that next pay raise, why don't you let at least 30 to 50% of that pay raise go towards increasing your savings? And before you know it, you're going to be at 20%. You're going to be a hyper saver, and you're going to be, all your dreams are going to come true.
I think that's perfectly said. The third thing, we already mentioned in investing, right? So you can control what you save. You get to control your behavior. You get to minimize your taxes. So I'm going to call that control word. You get to control your taxes. The other thing that you get to control is what you pay in expenses, what you pay in fees. And if you want to be a successful investor, you have to keep eyes on fees.
So number 3, low-cost investment choices. Now, this is the part that lays us naked or bare, and the fact that I like index funds. Mm-hmm. Now, a lot of financial advisors, a lot of you guys that are working with other advisors, you go back, index funds. My guy says that, well, I shouldn't do index funds. I should do active management because I got somebody who's watching the stock market at all times. Yep. Here's the dirty little secret and why most financial advisors actually for themselves are buying index funds. According to Spiva, the S&P 500 for the last 5 years has outperformed 82.14% of the actively managed funds.
So 8 out of 10 funds underperformed just buying the flat out index.
That's exactly right. So there's a lot of people out there going, wait a minute, okay, if the 80% are getting beat by the S&P, that means there are 20% of advisors and managers, and maybe my guy is so good, he's buying that 18 to 20%. I see what you're doing there, but here's the thing. Spiva actually tracks what they call persistence. They follow these 20% of these managers that are supposedly outperforming to see what percentage of them continue to outperform on a year-over-year basis. Listen to this stat. According to their research, only 0.91%, so that's less than 1%, of large cap and no mid cap or small cap funds managed to remain in the top quartile at the end of the 5-year measured period.
So if you were good enough and you could select 2 out of the 10 that might have done it in a 1-year period, you'd have to select 1 out of 100 that could do it inside of a 5-year period, or less than 1 of 100. It's impossible.
It's not going to happen. And here's the other dirty little secret that managers don't like to tell you. If you have taxable money, meaning taxable account, and so any dividends, interest, capital gains is going to be taxable to you, index funds, because they have very low turnover rates. Because think about, when does a new fund get put in, when does a new stock come into an index fund? It's when they turn over the index fund, where they kick off the Xerox and then they bring on the Google or whatever. I'm just using very simple examples. That's the only turnover. So there's very few taxable distributions that occur in index funds. So a lot of wins in that. I know that lays bare. Because a lot of financial advisors are still pushing managed products, and managed products with big commissions of 3 to 5% on those A shares. I think there's a better alternative. So I just want simple is buying those low cost investment options. Like I said, if you're less than $200,000, maybe even look at those target retirement funds.
That's a great solution.
Great options out there. Number 4, understand your investments.
Now this one I think is so funny, Brian, because I would say that one of the things, again, what we do for a living, we get to help folks make wise financial decisions. A lot of what we do is folks will come to us and they've had some success. Maybe they're successful in a different field in their career, and they've been sold something or they've bought something, they've participated in something, and they come to us and they say, I don't know what this is. I have no idea what I've bought. I have no idea why I have this. And so what we try to do is we try to make the complex simple and break it down. But the question we always have to ask them when we talk to them is, okay, well, why'd you buy this in the first place? And you know what the answer we most often get is?
What?
I don't know. I don't know. It sounded good.
So that's what I think. If really, you just heard me telling you that index funds are going to be your friend. Why buy some complicated strategy? I will tell you, coming from a public accounting background, I have CPA friends that come to me with all kind of schemes. I use the word schemes appropriately.
Yep.
And I'm like, there's no way I'm doing this,
No.
because I have seen too many oil and gas partnership and tax havens blow up, from other schemes, that I'm just not going to do those type of investment things that are not what I consider straight and narrow, that are going to get me through this and probably do a much better job with a lot less complication, a lot less stress, and going to help me reach my financial goals. So understand what's going on in your investment portfolio.
If you couldn't take what the advisor says to you or what the investment company says to you, take that information, go and repeat it to your neighbor and be able to talk about it intelligently, might not be the best thing for you.
I've heard you say it in a different way too. I always liked it because I thought you were going to say it, because I've heard you say that example. You say if you can't turn around to somebody in a grocery store line and tell them about your investment, it's probably not for you.
That's exactly right.
I always thought that was a great analogy.